So, what's next for Alibaba and Neo and JD and Pinduoduo? In my previous video, we talked about how some of the retail favorite Chinese stocks were all added into the list under the HEFCA Act. Although Alibaba is currently still not on the list, we know that they will be next after they officially close their financial year for 2021. What? We also know that you should like the smash button before we carry on with this video. And I also heard that every like button helps alleviate the China-US tension. Now, we understand that the headline delisting risk has been a concern and a drag on Chinese equities ever since President Trump enacted the bill in the name of protecting retail investors from fraudulent Chinese companies. So theoretically speaking though, as long as your own broker offers you access to other international markets, there should be zero worries from your perspective as an investor. But please, don't mix up the concept of delisting with VIE. Delisting is delisting, VIE is VIE. We can leave the topic on VIE for another day, but if the Chinese government decides on one fine day to invalidate the entire VIE structure, regardless of where the securities are listed, USA, Hong Kong, Singapore, or even China, nothing counts. So back to this delisting topic, which is a follow-up from the previous video I made on the 5th of May, one of the more notable companies embroiled in this entire saga was Neo, and their investor relation has then released a statement publicly commenting on the company's course of action and their public position with regards to HEFCA Act. So right after the inclusion of HEFCA, Neo publishes this, stating that they have been actively exploring possible different solutions to protect the interests of their stakeholders. Subsequently though, on March 10th, they also completed a secondary listing of its Class A ordinary shares on the Hong Kong Exchange itself under the stock code 9866. Quite similar to Alibaba with 9988. So the shares on the Hong Kong and US exchange are fully fungible as well, just like Alibaba. Clearly, this is not like the case of Didi, where they got into the crosshairs of the regulators. So as you can see, Neo started trading publicly on the Hong Kong exchange since the 11th of March, very much like other counterparts such as the Alibaba and JD. So on top of just being fungible between both exchanges, there was also a recent update where the Singapore exchange gave a conditional nod to Neo for a secondary listing in Singapore as well, which is my own home country. So this allows investors to trade fully interchangeably shares that are already trading on another exchange. So I guess we can put it crudely. Singapore regulators must be blind and they're exposing Singapore retail investors to a huge amount of fraudulent risk. They must have lost their minds. But in all seriousness though, I think Singapore have been attempting to woo many of these big Chinese companies to really establish ourselves as the financial hub in our region, but to not much avail, and it seems like this tension is providing for more opportunities for dual listing in our markets as well. So if you were to look at this delisting tension on the aggregate, it's going to be a lose-lose situation, but definitely more disadvantageous to one party. So firstly, the Chinese companies no longer have access to huge amount of liquid capital to raise funds and to propel up and rising innovative businesses, while US investors on the other hand, or capital, loses easy access to Chinese equities. So some of you might be wondering, how is this even a bad thing for America? You can't really claim that you are the best and the most matured market out there if you don't even have companies in the second largest economy available for investors to plow money in. So it's like saying I'm the best pastry shop in the town, but I don't sell you donuts. Okay, that's probably a very bad analogy because I know some of you will hate me for liking donuts. But I guess you get my point. However, this then opens up plentiful and a plethora of opportunities for other markets that aspire to be the financial hubs or to be the enabler of their region or continent. And Singapore is just one prime example. So implicitly, it also signals to the rest of the market participants that the US market might not be as open or as welcoming as we used to think of them, further wearing down the trust of the system. But do you know what you can trust? Trusting that you'll get sign-up rewards from signing up for credit cards, of course. So from now until the 11th of May 2022, if you sign up for the Standard Chartered Smart Card, you'll receive a Sony wireless earbuds worth $379 for free. What? And you get to enjoy up to 6% cashback in the form of rewards points with no minimum spending required. Furthermore, there is no annual fees attached to it, and you get 3 months of Disney subscription. No hate on Netflix, of course, I have both. But for those of you who have a higher spending habit, you can sign up for the CIMB Visa Signature to get $200 cash as reward and get to enjoy up to 10% cashback on your purchases, with a minimum spending of $800 in the statement month. Head down to the link below to sign up for either the Standard Chartered Smart Card or the CIMB Visa Signature today. Or why not to take advantage of both rewards now? Don't let this 100% ROI deal get away, and it expires on the 11th of May. So for long-time viewers, I believe you already know my core position. I'm the least concerned about the delisting event. It should be viewed as a non-event, especially if you have access to the Hong Kong market. But I'm 69% confident that if the delisting event really comes into fruition, the stock price will 100% tank. After knowing this fact, what are you going to do? If you were to ask whether the current valuation have already baked this factor in, I would say probably yes, probably no. Because clearly, whenever this becomes headline news again, it sends the entire basket of stocks down. Essentially, market participants are currently just fooling around with the news cycle, and Chinese stocks are meme-worthy. You can see publications, regardless from Bloomberg, Reuters, Wall Street Journal, oftentimes quoting people familiar with the matter as if they have some groundbreaking discovery, and then thereafter debunk the same said news. What? So a recent example is the rumor that PCAOB officials are in Beijing to further talks about audit issues with the CSRC, but are later debunked by PCAOB officials, saying that they have not sent any personnel to China since 2017. So this creates more exciting headlines and momentum for people to trade on. But investing shouldn't be like my K-drama. It should be as boring as it gets and not so dramatic. But since I can't control the markets and the headlines, I will control myself. But I think for most investors, I think the second order impact is much more worrisome. As the tension drags on, you can see people in the individual countries all riled up with the increasing animosity. There are bound to be collateral damage in the process. So just a recent update on Friday, China ordered government and state firms to dump foreign PCs within 2 years, marking one of China's most aggressive efforts so far to eradicate key overseas technology from within its own sensitive organs. What? Is there really a need for things to progress in this particular direction? As a bystander, it pains my heart to see how the world is developing in this manner. So let's not forget that the stakes individual US companies have in China can be considered significant, especially to companies like Nike, Walmart, Disney, Apple, Tesla, and the list goes on. So this delisting is just one of the many on the laundry list that provides no tangible value in trying to iron out the differences between the two superpowers. So more time will be spent in such squabbles with a tit-for-tat mindset. I'm hoping for China to take the highway, of course. It seems like after 18 months of turmoil, the discussions surrounding China equities are almost always about the regulatory and the global environment rather than the company itself. What a world we are currently living in. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!